The invention of money. For thousands of years, humans traded directly. You had grain, your neighbor had cloth, and you swap. But bartering only worked if both people wanted what the other had. If you needed salt but only had chickens and the salt seller wanted tools, you were stuck. Trade was slow, clunky, and limited. Communities stayed small because growth required trust, and trust didn't scale. Then someone had an idea. Instead of trading things, what if we agreed on symbols that represented value? Shells, beads, and eventually metal coins became the stand-in. A coin wasn't valuable because of what it was made of at first. It was valuable because everyone agreed it was. Suddenly, you could trade anything with anyone. The farmer could sell wheat to the blacksmith, take coins, and buy pottery from someone else entirely. Exchange became fluid. Markets exploded. Cities grew. Civilizations expanded because people could specialize, knowing they could always trade their work for what they needed. But money created something else, too. It made wealth portable, storable, and unequal. Those who accumulated coins gained power. Those without them became dependent. Value stopped being about what you made and started being about what you own. Money didn't invent trade, it invented the idea that some people could have everything while others had nothing. It gave civilization a common language, but that language spoke loudest for those who had the most to say. The first banks. Once people had money, they faced a new problem. Where do you keep it? Hiding coins at home meant thieves could steal everything you own. Carrying wealth while traveling made you a target. There was no safe way to store value or move it across distances. Trade was growing, but trust was fragile. Temples and goldsmiths became the solution. They already had strong walls and guards to protect sacred objects and precious metals. People started leaving their coins with them for safekeeping. In return, they received a receipt, a piece of paper proving how much they deposited. Over time, something strange happened. Instead of withdrawing coins to buy things, people just traded the receipts. The paper itself became money because everyone trusted it represented real gold sitting in the vault. Then came the revelation. Goldsmiths noticed most people never withdrew their deposits. The gold just sat there. So they started lending it out to others and charging interest. They created more receipts than they had gold, betting that not everyone would ask for their money at once. Suddenly, money could multiply. A single gold coin deposited could become 10 paper receipts circulating in the economy. Banks didn't just store wealth, they discovered that money could work, grow, and reproduce while sitting still. But this also meant the system ran on belief. As long as everyone trusted the receipts, prosperity flowed. The moment that trust broke, everything collapsed. The rise of taxation. Empires needed resources. Armies required food, weapons, and wages. Roads had to be built, aqueducts constructed, and walls fortified. Kings couldn't fund everything through conquest alone. They needed a steady flow of wealth from the people they ruled. But asking for donations wouldn't work. Power required certainty, so rulers created a mandatory system. Every citizen had to give a portion of their harvest, income, or labor to the state. This was taxation, enforced by law and backed by punishment. Farmers surrendered grain, merchants paid in coin, laborers worked on public projects without pay. Refusing meant fines, imprisonment, or worse. The deal was simple: give us a share of what you earn and we'll protect you, build infrastructure, and maintain order. Taxation transformed societies. It funded roads that connected distant cities, armies that defended borders, and temples that unified culture. Empires expanded because they could organize resources on a massive scale. Public works employed thousands. Governments became permanent institutions instead of temporary warlords. But taxation also created a permanent tension. Citizens resented surrendering what they worked for. The wealthy found ways to hide their fortunes. The poor bore the heaviest burden. Revolts erupted when taxes climbed too high. Entire economies bent around avoiding or collecting payments. Taxation built civilization by pooling individual effort into collective power, but it also taught people their first financial survival skill: finding ways to keep what they earned hidden from those who demanded a share. The banking system. Early banks operated alone. Each one held deposits, made loans, and kept its own reserves. If a merchant in London wanted to pay a supplier in Paris, moving physical gold was slow, dangerous, and expensive. Banks existed, but they couldn't talk to each other. Money stayed trapped within individual institutions, limiting how far commerce could reach. Then banks started connecting. They formed networks, agreeing to honor each other's notes and transfers. A deposit in one city could fund a purchase in another through letters of credit. Trade accelerated because money could finally move at the speed of trust instead of the speed of cargo ships. But the real transformation came from a radical idea: fractional reserve lending. Banks realized they didn't need to keep all deposits in the vault. If 100 people deposited one gold coin each, the bank could lend out 90 of those coins and still cover daily withdrawals. Those 90 coins would be spent, then redeposited in other banks, which would lend out most of them again. 100 original coins became thousands in circulating currency. Economic growth exploded. Businesses could borrow to expand. Farmers could buy equipment before harvest. Entire industries launched on credit. Wealth multiplied faster than ever before. But this system had a fatal flaw. It only worked if everyone stayed calm. The moment people panicked and rushed to withdraw their money simultaneously, banks collapsed. There was never enough gold to cover every claim. The banking system created prosperity by lending the same money over and over, gambling that no one would ask for it all at once. The Industrial Revolution. For centuries, making things took time and human hands. A blacksmith forged one tool at a time. A weaver made cloth thread by thread. Production was local, slow, and limited by how many hours a person could work. Economies ran on muscle power, animal strength, and small workshops. Wealth grew incrementally because output couldn't scale beyond human capacity. Then machines changed everything. Steam engines powered factories that could produce in one day what a craftsman made in a year. Textile mills churned out fabric by the mile. Iron foundries cast metal in massive quantities. Production exploded because machines didn't tire, didn't sleep, and multiplied output exponentially. Workers flooded from farms into cities, trading fields for factory floors. They earned wages instead of growing food, becoming dependent on money for survival. Capital became king. Those who owned factories accumulated wealth faster than anyone in history. Railroads connected markets. Steamships crossed oceans. Goods that once took months to produce became cheap and abundant. But this prosperity came with a cost. Factory workers labored 14 hours daily in dangerous conditions for minimal pay. Children worked alongside adults. Slums swallowed cities as populations surged faster than housing. Wealth concentrated in the hands of industrialists, while workers barely survived. The Industrial Revolution proved machines could create almost infinite abundance, but it also revealed that efficiency and humanity don't naturally align. Production became cheap, living became affordable, yet somehow the human cost remained expensive. Machines made everything except dignity more accessible. The gold standard begins. By the 1800s, every country printed its own currency, and none of them agreed on value. A British pound meant something different than a French franc or an American dollar. Exchange rates fluctuated wildly. Governments could print money whenever they needed it, causing inflation to spike unpredictably.
International trade was chaos because no one trusted anyone else's paper. Then Britain made a promise. Every pound they issued would be backed by a specific amount of gold sitting in their vault. You could walk into a bank and exchange paper for actual metal at a fixed rate. Other nations followed. Suddenly, currencies had anchors: a dollar, a franc, a mark. They all represented a defined quantity of gold. This changed global commerce. Exchange rates stabilized because every currency connected to the same universal commodity. Traders knew exactly what they were getting. Investment flowed across borders because value was guaranteed by something physical. Economies synchronized. International business boomed because trust was finally built into the system itself. But the gold standard created a trap. Governments couldn't print money to fight recessions or fund emergencies without gold reserves to back it. Economic flexibility vanished. During crises, countries couldn't inject cash into their economies without mining more gold or buying it from others. Growth became limited by what could be pulled from the ground. The gold standard made money trustworthy by chaining it to metal, but that chain also locked economies into rigidity, unable to adapt when the world demanded change.